Hi everyone, my name is Vess Rusev and this is East Auckland Property Show. Today we're gonna do our monthly financial markets update with Brandon from IRefi. Hi Brandon.
How you going?
How are you?
Good as always.
Awesome. We haven't done one in a while, probably more than a couple of months, but now it's the right time to do it. So, Brandon, how do you see the global financial markets and the local financial markets at the moment, and what's the trend?
Okay. Well, I think the sentiment usually between New Zealand and any other markets, whether it's financial, whether it's commercial, whatever industry it's actually in, is that it tends to follow suit from bigger powers or bigger fish overseas. And over the recent, I guess, few years, we've actually pegged ourselves by saying, like, hey, our interest rate's going to stay low because everything's still low overseas, particularly the US.
Yeah.
And so it's actually pretty prudent that we're doing something now, because finally, after what seems to have been a pretty long slumber here of low interest rates, we're kind of pegging that maybe in the short term things might still, and we never really make predictions on this end, but this is the general sentiment. So it's not myself saying, hey, this is going to happen, but more so that we've been in this low interest rate environment, stuff going sub 4% at some points, stuff is still low. That 1 year rate's still between 4 to 4.2% at most banks, real competitively. That's if you're getting a good discount. The carded rates are sitting at about that 4.4%. And a little bit higher, that's on the 1 year rate. But what we're seeing, it's a little bit difficult to predict what's going to happen over those 3, 4, 5 year terms, and we're seeing those rates actually remain quite high. So I guess the sentiment is because we've seen the US, their central bank, or the bank that actually prints money or decides to stop printing money, has made that decision to stop printing money.
Okay.
And the way that's done is that they decide not to commit any longer to buying assets from the government to redistribute money into the economy, which has the same effect as rising the interest rates there. So generally the sentiment is that we flow on a couple years late to what happens in the United States too. So it's not an overnight shock or anything like that. Stuff's certainly still asleep on this end in New Zealand, but we're picking that maybe over the short term there might be a slight increase. We don't know to what level, but it would most certainly be something to
And by saying short
about.
term, what do you mean? What's the period?
Well, short term, I think up to 2 to 3 years are pretty safe.
Okay.
Usually for borrowers, and this is class advice, but usually for borrowers who have borrowings of over $1 million and several properties maybe, we'll be recommending rates to go, or at least some portion of your lending to be fixed on a 3 year term anyway. Even though it is a little bit high, it doesn't necessarily have to be a third of the lending in some instances as well. But it's worthwhile to just have some of your loan just fixed for a little bit longer so that you can weather anything if there is a major shake-up in the future.
Okay.
Yeah, but certainly something to keep an eye on and something to make sure that you speak to your broker or financial advisor about.
But in general, in short term?
Yeah, short term I'm still thinking, short term what we've seen is the banks have still remained very competitive. Really no net difference between the 4 major banks as well, and then obviously Kiwi Bank really competitive still too, and all the smaller banks as well, like the Cooperative, SBS, TSB, are still doing really good job of really good interest rates for their clients too. So it's really competitive market, nice low interest rates for now. People want to lend the money, so it's just about being there and getting the loan approved and finding a place. So
Awesome.
So
how do you see, or do you see any influence from the current government or the current political situation on the whole market, and just saying the whole market, and it's, I mean the financial market, the real estate, all the markets?
I think in terms of the current government, not so much in the financial market. I think that the financial market is certainly the second. It's kind of like the second stage of how the government will influence the financial market through whatever they do through KiwiBuild. Because I believe that with KiwiBuild, the interaction directly with building all these properties, if they're successful in pulling it off, that's more likely to affect stock and stock prices.
Yeah.
And then with that, obviously the supply demand.
Yeah.
So if that's affected, and then you have a decrease because of, say, for instance, if property prices were to drop, and there's a decrease in the sentiment of the public is that they don't want to buy, or they want to buy for a little bit lower, banks may not be as profitable.
Yeah.
New Zealand banks they've actually posted bigger profits here than they have in Australia, so they're actually pretty robust. They don't have to feel the stress on their end here, unless if they're meeting really audacious targets, which I don't feel that they, well, maybe they will, I'm not too sure, I'm not inside there anymore. But I guess the fact, or I guess something to consider is it depends on the stock, and if the stock sells or if it doesn't sell, and who's buying the stock. And that's all related to the rules that they put in place.
Yeah.
So right now I think some of the rules are, there's a small section of people that can actually go on and buy some of those properties. I foresee that probably being opened up. There's been speak of the Reserve Bank, which isn't the government, but the Reserve Bank opening up the deposits from 35% to 30% for investment properties later in the year.
Yeah.
So a few Westpac economists, I think one of the Westpac economists has predicted that. I feel like that would be pretty prudent because we've seen like what we're going to talk about, a little bit less investor activity too.
Yeah.
So, yeah.
Okay. Yeah. Who is most active on the market right now? Do you see first home buyers or investors or mom and dad, upsizing or downsizing?
Yeah.
According to what you see on a daily basis?
Yep, if we're going, we see a bit of everything, but if we're going what we're seeing the most, it's certainly first home buyers.
Yeah.
I've still got clients who are thinking on a long-term property strategy. If that's part of your strategy, then the best time to buy a property was yesterday. And that's, and that will stake if you're thinking of that 10, 20, 30 year time span.
Yeah.
Certainly we're seeing people picking good stock. I think the sentiment is that good properties are selling, and that's reflective of who's buying it. If you're buying a rental investment, you're not going to go out and buy a 4-bedroom that's on Takatai that looks over the marina.
Yeah.
But you're likely to go and buy maybe a new build. If it's going to be from any of the majors, a Keith Hay or GJH, you're buying something in a good area with a town centre nearby, low in price, that sort of stuff.
Close to public transport. Yeah,
but there's that section of the investors. There's fewer of them when we're comparing to the amount of first-time buyers that we're now seeing in the market. And I think it's just because of the exit of everyone trying to invest. It's just the people who are who's left are the people who are actually committed to investing, and there's plenty of stock for them to actually take a good pick from in terms of investment. And we're seeing a little bit of trading happening as well, but again, it's the cream of the crop that's selling on that end. But family homes are always up in contention.
I can confirm that in the last probably 6 months we're seeing a lot more activity from first home buyers. The other thing is that we're seeing is because a lot of the properties are sitting for a long time on the market, we see also a lot of activities from flippers, people who are buying, renovating, and then selling them in 6 or 8 weeks after they purchase the property. It's risky. But if you know how to go about the whole process, most of them are very successful.
Okay, cool.
Yes. So what we see is first home buyers. Of course, a lot of them are struggling with finance. Has there been any changes with the approval process of first home buyers with the banks?
Or? That's an excellent question. I think something we can touch on really briefly is how different loans are assessed. A loan that you take from a bank where you're contributing a 5 or 10% deposit or 15% deposit is treated ultimately a heck of a lot differently when you're bringing a 20% deposit.
Okay.
So when you bring a 10 or 5 or 10 or 15% deposit to a bank, they actually consider that loan to be a little bit riskier. So I think that the sentiment of the public is that the bank has a big pile of money. The way to think about it is the bank has a big pile of money for 5% deposits. The bank has a big pile of money for 10% deposits.
Segments,
Exactly. And where the bank gets money from, if it's an international funder, they will have said, well, look, we're borrowing this money from you for this purpose, and therefore it's a little bit riskier. So there's that price is actually built in when they're actually borrowing the money too.
Yeah.
So that money is actually a little bit more expensive for them. So $1 is not actually equal on the bank's end.
Okay.
Okay. So when they lend that money out to the individual, that can be priced differently as well. So generally, you're not going to get a really good discount on rates because it's a riskier lend, because if anything happens to the market, if you buy it with a 5% deposit or 10% deposit, say the property decreases in value by 5 or 10, well, the money's essentially not there.
Yeah.
But the bank also does take a riskier stance. If they were to sell it, are they going to recoup all of their funds is the question that they're asking. And with a lower deposit, the margin for them to do so, because it comes out of the deposit first, so it's actually decreased. So they assess those loans a lot harsher. For instance, if an application is with a 5% deposit, they rely on a big surplus of income after all the expenses come out.
Yeah.
And the biggest expense that we actually see in any statement of position when a client's applying for a mortgage is the mortgage expense. So you might, when you're sitting at home doing your budget to figure out if you can have a mortgage, you might calculate it at 5%, but the bank calculates it at 7 to 8%. So some banks are lower and some banks are higher.
Yeah.
So that's different, and every bank offers, well, they have their own risk assessment criteria that they go through. So they calculate it higher, which means that of maybe you think you're going to have 2,000 left at the end of every week, you might have, say, 500.
Okay.
And 500 is too small of a margin usually after all of your expenses at the major banks for you to purchase a home with a 5, 10, 15% deposit. And the application can't really rest on other things that you'd receive money from. Say, for instance, if you're receiving commissions or bonuses, they might not take that income into consideration when you have a low deposit. As well as if you're having bought, if your first home, it's you and your partner and you're having 2 flatmates, they won't use border income as well. Okay. So even though you're going to receive that, they won't allow you to do it. So it's trying to hit a moving target, and you've got this big puzzle that's sort of sitting in front of you. And it's all about going to the right bank and at least having someone look over the situation. I think that it's most certainly the biggest change that's happened, because there's money to lend at 10% deposits. Don't get me wrong, banks want to do it, but it's the calculation of the mortgage expense, and that's really what's eating away.
So do most of the online mortgage calculators take in consideration those, not 5 but the 7%?
So if we're thinking about the bank ones, I'm gonna have to actually double check that. Okay. Because I certainly know that there are repayment calculators.
Yeah.
In terms of affordability calculators, it's a good, take it with a grain of salt. Be ready for it to go up 200,000 and probably down 200,000 as an estimate, because it depends. There are so many different factors, and it's difficult for an online calculator to fix all that. Because
do you have an online calculator on your website? Or?
We do. Again, and it's very difficult to build something to take into consideration, because if there is something that you can present does still need an explanation to figure out whether or not it can be.
But we can send people to your website so they can
start it. Yeah, for sure.
They can start it, and if they have any questions, they can
100%.
I mean, get in contact.
If you're getting an approval from a bank or an advisor, you can just always ask, hey, how is this being calculated?
Yeah.
That's it. And they'll guide you through it pretty easily, and you'll be really informed, because it'll give you an understanding as to why you can't or why you can borrow as much as what you're borrowing.
Yeah. Okay.
So Brandon, if you have to give one tip to people who are looking to borrow money, what would be that?
I will certainly, if I'm giving one tip for borrowing money, I think credit cards. Credit cards, even if you don't use a credit card. Say if you have a credit card that's got a $10,000 limit on it, you don't draw anything on it, it's an emergency credit card.
Yeah.
When you go to apply for a mortgage, it will calculate 3% of the total credit card limit and add it as an expense. So that's one thing that can often be misinterpreted or just not looked over when you're going to borrow a mortgage. So when you're going to borrow a mortgage from a bank. So that's one thing. It's a pretty basic concept for me to dictate to anyone to say.
Even if it's the same bank issuing the card and the one that you're going to borrow the money?
100%. Yeah.
Okay.
So any bank, any bank. Credit, for sure. Even if you're so you can increase your borrowing capacity, and this isn't a riskier thing to do, because you're not obvious. If you get rid of your credit card, okay, that expense doesn't exist, even
Yeah.
if you haven't used it at all. If you have used your credit card, then obviously that's going to be included because they'll see the expenses when they go in there. But if you're not using it, you can cancel it, and then 3% of that will be added onto your surplus income,
Yeah.
which could allow you to borrow a little bit more.
Okay.
Yeah,
Okay.
just a little tip.
That's a good tip.
Yeah.
That's a good tip. Okay. Yeah, I think when
Cool.
we're done for today,
Perfect.
we need to do those a little bit more,
Yeah.
be a little bit more
Active.
consistent.
Yeah.
Yeah. Let's try to do it at least
Cool.
once a month,
Okay.
or at least
Yeah.
once every 2 months, or
Yeah.
when we have a massive or a major change
Yeah.
in the market.
Yeah.
And we can have probably one in spring.
Yeah.
It's probably beginning of September.
Cool.
Yeah.
Yeah.
Okay. Awesome. So that was it for today. I'll leave Brandon's details in the description below. Also a link to the calculator, so you can go and play with it. And if you have any questions, just give him a call or send him an email. That's all for today. Thank you. See you next time.